Good day. My name is John T. Sachs. I'm a partner at Geltech, and joining me is Jeremy Squier, the Managing Director of Wealth Associates Bespoke Solutions. Jeremy, thanks for joining me.
Hi, John T. How are you doing today?
Yeah, very well, thank you. The topic for today is really to understand Wealth Associates' approach to Section 12J investments and really what the key aspects are for your firm when really understanding the type of Section 12J investment which you would support for your clients. But before we get into the topic, I think maybe to give the viewers some understanding of who you are and what your business does, could you give us a quick introduction?
Okay, great. Yeah, so Wealth Associates is a group of financial advisory practices under the Wealth Associates banner. Wealth Associates started some 14 years ago and acquired a number of practices, one of them being Bespoke Solutions, established practices with the objective of having a high level advice group with independent advice for clients. So we also have investment offerings within the group, and but in essence, we're an advisory firm.
Okay, thank you. And your typical client base, I assume South Africans. Is your client base predominantly focused in Johannesburg, or do you have more of a national footprint?
Yeah, so we actually have offices. We have two offices in Johannesburg. We have one in Cape Town, one in Bloemfontein in the center of South Africa, and then we have one in KZN as well. So we actually have a fairly national footprint. Our client base is very much South African, unless there are South Africans who migrate elsewhere in the world, and then we continue dealing with those folks. But yeah, largely South Africans.
Okay, and then from a 12J perspective, has your business been considering Section 12Js for some time, and really what's your approach been when selecting a Section 12J investment?
Yeah, so we first really started looking at 12J probably just over 3 years ago, and as you know, the initial structure of the industry was not that appealing, and also it was categorized as a high risk, good way to lose your money type of investment proposition. But yeah, I'll say that thanks to the likes of Geltech and one or two other operators, the industry has definitely worked with Treasury. It's probably a better regulated industry, and there's much more certainty in terms of what we as advisors can offer our clients. It's because it's an equity investment in smaller businesses. Obviously, there's a higher risk component to the investment compared to typical collective investment scheme type investments, which is the majority of the makeup of investment portfolios of our clients. But we see it very much as an add-on for slightly more sophisticated, higher net worth clients who need a satellite approach to their core investments. And the thing that we like about the way Geltech has put things together is that there's also differing opportunities for clients to come into different types of investments. You've got obviously the property backed, you've got rental backed, and then you've got the real entrepreneurial type opportunity. So we can actually match the offering to the client's needs.
Yeah, thanks. I think obviously given the more high risk nature of 12J, or the perceived nature, having a diversified investment obviously reduces that type of risk. And in your experience, what type of returns would you anticipate from these type of investments? I think what many Section 12J funds have been guilty of in the past is punting the tax benefit. Obviously, this is a tax-driven incentive or investment. You wouldn't want to invest if you didn't have a tax liability. But the tax benefit alone equates to a return of 8.3%. So, if you look at your client's portfolio, in addition to the 8.3%, what type of returns would you anticipate?
Yeah, so because it's as you say, discounting the tax effect, because it's an equity investment. I mean, we would look at a typical equity investment of giving you around about a CPI plus 5, perhaps 7. So with that in mind, I mean, we'd look for a similar type of return profile, perhaps a little higher, but it's not as much about the kind of absolute return that one's targeting. In other words, there's that whole thing of you optimize the risk return profile, and so we're not looking for outlandish big bang type of returns. Rather look for investment opportunities which are going to give you probably more of a smooth type of return profile, and but of course it's going to give you a good CPI plus return over time.
Yeah, I think one of the benefits of 12J is, from an investor's perspective, depending on their risk appetite, there's really there are so many different types of funds in the market, not necessarily achieving the return that they're anticipating at the current point in time for numerous reasons. But if you're a high risk investor, you could go into a fund that that is aiming to return enormous returns, 35-50%. Whether they'll achieve that or not, the jury's still out. But then there's also the conservative, low risk, property backed, asset backed, asset underpinning investment, which I've seen not only in our funds but other funds providing a return on an annual basis, which is nice, from an investor's perspective. So not only by investing, will you not have to pay the tax, or you would have paid the tax anyway and received a refund, but you'll also earn, for example, a dividend income, which I think is very welcomed, particularly in these markets. I think given the current times, COVID-19 is obviously on everyone's minds, particularly in the investment world. Do you think, and I'm going to put you on the spot a little bit, do you think, given the poor performance of the equities market, do you think that the alternative investments, and not only 12J, do you think there'll be a spike in alternative investments?
Yeah, they probably will at the very high net worth individual level, because as we know, that type of investor is actually very close to the action through some very highly competent advisors that they work with. Whether it'll transcend down into the further down into the sort of general market or not, time will tell. But of course, one of the problems with the listed market environment is that it's hugely imperfect in the short term. So you just look at the way that the equity and bond markets kind of collapsed around the third week of March, when the whole COVID thing became really front of mind. I mean, it was a completely oversold type of situation, and then the rebound to date has been probably an over. I mean, it really has surprised everybody. So that's one of the problems that you have with a listed market type scenario, because in theory, I mean, it kind of brings buyers and sellers together, but whether it reflects the true price or not is, time will tell. I mean, of course, the true price will come out over time. Whereas the beauty with unlisted investments, so alternatives included, is that you don't have this fixation with looking at the share price every single day, and so the fundamentals will actually determine what your return is. So if the business does well, it's cash flow positive, it's generating good returns, and it's paying dividends, that is a much more, you have a much more direct flow through. I guess the biggest risk is that you have liquidity at the end of the period when you need to get out.
Yeah. So, on that point, and that was going to be my next question is, what is your feeling around, clients being invested for a minimum period of 5 years? It's hard to compare other deductible investments like an RA where, if for a younger client, you're in for many, many, many years. But the 5-year lock-in period, have you seen that being a big deterrent for your clients? Or, as you said earlier, this is really for a niche portion of your client base who potentially, they have the liquidity and 5 years isn't an issue. What's your feeling around the 5-year term?
Personally, it's a complete non-issue in my life because in terms of the way that we advise clients, because of course these are long-term investments. So the fact that you locked in is not actually really an issue. I mean, it's and clients typically don't really see it as an issue either, because if you took something like an endowment type contract, which is used also for specialized kind of tax structuring and so on, it's not an issue there, and so we don't see it being an issue in the context of 12J either. So I think anyone who is concerned with liquidity and therefore is concerned with the 5-year period is probably not shouldn't be investing. They shouldn't be considering it at all, because again, you don't bet the farm and in 12J, and you make sure that if you have liquidity requirements, it actually is available elsewhere in your portfolio.
No, I think you're spot on. Jeremy, thank you very much. Appreciate your time and your insight, and look forward to having another discussion with you in the future.
Pleasure, John T. Thanks. Okay.
Cheers.
Keep well.